So I'm 28 years old and I have a net worth of just over $250,000. It's taken me over 5 years of hard work and diligent saving to get to this point. But in today's video, I want to show you guys my plan for reaching $500,000 by the age of 30. This is not something that's possible to do through saving alone. A lot of this is going to involve returns on my stock investments as well. I really want to show you guys how I'm planning to hit $500,000 by the time I'm 30. Not only through diligent savings, but also from the additional money from my side hustles and investment returns as well. So here's my current stock portfolio, which is worth around $200,000. The portfolio consists of 3 ETFs. Firstly, I've got about $120,000 in NDQ, which is an ETF that tracks the NASDAQ 100. Now, for those of you who don't know what the NASDAQ 100 is, it's basically the top 100 stocks on the New York Stock Exchange. And it primarily includes tech stocks like Apple, Amazon, and Facebook. Now, with this ETF, you also get dividends, but it's only a very small amount. The primary reason why I bought this ETF is because I think it will deliver outstanding returns in the long run compared to the S&P 500. When you look at all of these big tech companies, you can see that they are only continuing to grow and innovate. So in my opinion, it makes sense to put as much money as possible into this ETF. And this is why it makes up about 60% of my overall portfolio. But that being said, it's always important to diversify, which is why I'm planning to branch out into other ETFs as well. Secondly, I've got about $60,000 on IOZ, which is an ETF that tracks the top 200 companies on the Australian Stock Exchange. I've been pretty lucky that I bought this ETF about a month ago because it's only continued to increase in value since then, although not by very much. I do think that the ASX is just going to continue rising over the next 12 to 24 months, particularly given the fact that the price of iron ore is only going to continue to increase now that international economies are starting to reopen. I should have really gotten into this ETF a lot earlier though, because in March last year, it dropped to $19 and hovered around the low 20s for quite some time. Regardless, I'm still happy that I managed to get in at about $28. And thirdly, I've got about 17 grand on Robo, which is an ETF that's made up of growing companies with exposure to the robotics, automation, and artificial intelligence industry. Most of these companies are in the US, but the ETF also has exposure to Japan, Germany, and Chinese markets. Again, I wasn't very smart with this investment as I put all of my money in at $94 when the ETF was at an all-time high. And since then, it's dropped back to $88. That being said, I think in the long run, this ETF is just going to increase in value as the world moves towards a greater reliance on automation and AI technology. Since inception, this ETF has returned about 20% per year on average. Obviously though, this investment is a much higher risk compared to the NASDAQ and the ASX 200 ETFs. So I've only got about 10% of my overall portfolio in this ETF. It is very well diversified and is made up of about 84 companies, with the largest holding being 3D Systems Corporation, and that makes up only 3.3% of the total portfolio weight. I think it will continue to grow over the coming year, but I'll probably wait and see what it's looking like towards the end of 2021 and may invest more into this ETF. I wasn't very smart with these ETFs though, because I put all of my life savings into them when the market was at an all-time high. Subsequently, the NDQ ETF went into a bit of a nosedive, as there were concerns that the US Federal Reserve was going to raise interest rates later on in the year. And this has prompted a move away from growth stocks into value stocks. A better approach would have been to have dripped my money into the stock market, or at least spread out this investing over multiple time periods. I think the key thing with these ETFs is just to make sure that I don't sell them when they go down in value. And also to make sure that I hold them for at least 12 months to make sure that any gains that I make on them are not taxed at a full rate. Therefore, my plan over the next 12 to 24 months is to try and save as much cash as possible, moving forward and then trying to drip feed that cash into these ETFs at their lowest possible market price. By saving cash over the coming year, it's also going to mean that I have security for living expenses in case I lose my job. In my opinion, there are two big factors when it comes to making investment returns. Firstly, it's how much money you put into the market, and secondly, how long you leave your investments in the market for. So in reality, if these ETFs do go down, I'm just going to buy more. And if they go up, then my original investment will have made money. So it's a win-win situation. I will admit though that there is a lot of nervousness in the market at the moment. No one knows where the stock market is going to be in the next 12 months. And a lot of people are worried that the US Federal Reserve will have to raise interest rates later on in the year in order to combat inflation. This in turn is going to decrease the value of future expected cash flows of companies with high growth potential, and as a result, see investments into growth stocks go down. What this may mean is that my NASDAQ ETF may decrease in value throughout this year, and my IOZ ETF will likely go up in value during this time as well. So my strategy is going to be to invest more and more into the NASDAQ ETF if it continues to go down, or alternatively branch into other ETFs in order to diversify. Another ETF that I have my eyes on is the Vanguard US Total Market Shares ETF. This ETF basically just tracks the top companies in the United States as a passive index fund. It's made up of over 3,500 US holdings and only has a management fee of 0.03%. So if we assume an average annual rate of return of 10%, then over the next 2 years, this initial investment is likely going to increase to $240,000. Of course, this is just an average, which means that it could either decrease in value during this time or remain flat or increase at a high value as well. But I believe that so long as interest rates do continue to remain low over the next 2 to 3 years, the stock market, in my opinion, is just going to keep rising and rising. Which brings me to my next point of how I'm going to make it to $500,000 over the next 2 to 3 years. Well, to start, I want to talk about how much money I'm making in my current full-time job, as well as also from my side hustles. I've recently started a new job that's paying me certainly a lot more than what I was earning 2 to 3 years ago. I'm going to make a separate video on how I actually got into this role, but for now, I'll just say that my current salary is about $120,000 a year. I'm also looking to pull in an extra 10 to 20 grand this year from my tutoring side hustle, and also plan to save at least 70% of my income. So after tax, this will probably come out to about $60,000 saved every year. And so what that means is that over the next 3 years, I'm looking to add about $180,000 to my total ETF portfolio. Of course, this should hopefully mean that the returns on my investments also increase during this time as well. So going back to my original investment, if we assume an average annual rate of return of 10% per year over the next 2 years, then I'll probably be looking at about $240,000 to $250,000 by the time I'm 30 years old. So adding to that another $180,000, I'm probably going to be looking at about $400,000 to $430,000 plus hopefully some investment returns. That being said, I'm still about 70K short, so I want to talk to you guys about how I'm planning to fill that gap. One way I'm planning to do this is by selectively investing into the stock market whenever it falls from recent highs, as opposed to just dumping a large amount of savings into the stock market at a single point in time. Looking back at the NASDAQ 100 graph, you can see that there are dips throughout the last 12 months. So by buying into these dips, I'll be looking to get in at the cheapest possible prices, as opposed to buying in at all-time highs. Of course, this may not necessarily work given that no one can predict where the share market is going to be in the future. But one obvious strategy is to simply just buy in whenever it falls from a recent high, like for example, a couple of weeks ago. I'm also looking to buy into travel stocks like Webjet, Flight Centre, and Qantas, because I believe that these will eventually make a huge comeback. Perhaps I'll even buy some Bitcoin as well, but certainly not at this price because it's just way too expensive at the moment. But by doing this, I'm pretty confident that I can get some pretty good investment returns over the next 2 to 3 years. I think the key message that I keep coming back to here is simply just being able to invest more and more money into the stock market and not having to sell at a loss, and never being in a position where you have to take money out of it. That way, I'll be able to sell my ETFs at a price that I'm happy with, and the longer that I keep them in the stock market, the longer that they will just increase in value over time. Therefore, by reducing my current expenses and increasing my income as much as possible, I'm hoping to make more and more investment returns. Now, also over the next 2 to 3 years, I also really want to build up my tutoring business. And at the moment, it's basically just a side hustle that's generating a bit of pocket money. The problem that I have with this though, is that it's not really expandable. I'm just simply trading my time for an hourly rate. Therefore, the only way that I can really increase my earnings is either by increasing my hourly rate or trying to take on more and more students, or potentially even doing other types of work like group classes as well. This is all well and good, but I've basically raised my prices to the absolute maximum limit that people can afford. And I've only got a very select number of students. So what I would like to do instead is actually create an online tutoring business. And this is going to involve putting educational videos on the internet and then asking students to sign up by basically paying a small monthly cost or a very small upfront fee. I've been thinking about this for a while now, and this is definitely something that I'm hoping to actually build and establish this year. I think the best way to make a solid income is being able to generate a scalable business that doesn't actually involve trading one's time for money. I'm also hoping that this YouTube channel continues to grow and I'll be able to direct more traffic from this channel to the tutoring website. And you can hopefully see the growth potential from there, expanding into other educational courses beyond statistics. So hopefully this will start to bring in some additional income beyond just simply tutoring students one-on-one. Now, a large part of this plan is also going to involve saving a significant amount of money over the next 2 to 3 years. And what's great is that I've identified in other videos as well that a large part of this is really just cutting back on daily expenses, like takeaway coffees and lunches as well. And of course, this is going to involve cutting back on some unnecessary expenses. Now, I should mention that at least one of the advantages of COVID is actually being able to save money because you can't travel overseas anywhere. Don't get me wrong, I am definitely a huge fan of travel, but it is very expensive. I do think it's going to be at least another 2 to 3 years before international borders do even start to reopen. And then there's going to be an opportunity to travel. But in the meantime, this is just an opportunity to try and save even more money. And of course, the final part to all of this is to eventually try and make other sources of income beyond just having tutoring as a side hustle, such as like this YouTube channel or getting another job that pays a really good hourly casual rate. YouTube, in my opinion, is a really good way to start a side hustle because I find it so enjoyable to create content and see my ideas come to life in these videos. Ideally as well, I would like to be making decent side hustle income from this YouTube channel as well in the next 2 to 3 years, whilst at the same time bringing in substantial passive income and investment returns from my ETF portfolio.